Silver just moved 31% in under 30 days, from $61 to $80.20 as of tonight. That is not a rounding error. That is one of the fastest single-cycle recoveries this metal has produced in the current bull phase. And it happened while the institutional money that has driven every major precious metals rally in the last 4 years was sitting entirely on the sideline. Let that settle for a second. The hedge funds, the managed money accounts, the global macro strategies that built and rode the move from $2,000 gold to $4,125 gold, they reduced their precious metals exposure during the March correction and have not come back. Ole Hansen, head of commodity strategy at Saxo Bank, one of the most rigorous institutional research desks covering commodities in Europe, confirmed this week that hedge fund net long gold futures positioning hit a 25-month low in the week ending April 7th, 25 months. The last time professional capital was this underweight precious metals, gold was trading near $2,000 per ounce. Gold is now at $4,125. Silver is at $80, or $20. The institutional fuel that drove the bulk of this cycle's move has not re-entered. And the metal already moved 31% without it. If you hold silver, or you've been watching this price and trying to figure out whether $80 is a buy or a trap, the next 7 signals are the most important data you'll see today. Because what moves this price from here is already in the system, it just hasn't hit the screen yet. Tonight, the World Silver Survey 2026 published its full annual supply and demand report. That is the most authoritative primary source dataset this market produces in any calendar year. March Producer Price Index data dropped Tuesday morning with a reading that should have led every financial broadcast in the country and didn't. And sitting underneath both of those releases is a positioning anomaly in the professional futures market that has not appeared in 25 months. And the last time it did, it marked the beginning of the largest sustained precious metals rally in modern market history. I'm going to connect all of it. Let's get into the 7 signals. If you are finding this analysis useful, subscribe and ring the bell right now. The World Silver Survey 2026 dropped today, and I will be back within hours to walk through the full supply and demand tables. You want to be here for that. Now, signal 1. Let me tell you something about the way professional capital moves before the price confirms it. Institutional repositioning does not arrive as a press release. It does not ring a bell when the setup has matured. What it does is leave a specific measurable footprint in the futures positioning data, and that footprint is visible to anyone willing to read it before the price catches up. Ole Hansen at Saxo Bank reported this week that hedge fund net long gold futures positions hit a 25-month low in the week ending April 7th. That is not a mild reduction in exposure. That describes a structural retreat to a positioning level that has only appeared once in just over 2 years, at the very beginning of the current precious metals bull cycle, when gold was sitting near $2,000 per ounce. The funds sitting at that underweight today are not funds that missed the move from $2,000 to $425. They are the same category of managed futures and global macro strategies that built and rode most of that move, then reduced into the March correction alongside the broader market liquidation. They're not permanently out of the trade. Their own mandates mathematically compel them to return when the inflation data is printing what it printed this week. Hansen said it directly, and it matters. Lean positioning reduces the risk of further long liquidation and creates scope for renewed buying. That is the language of a professional analyst watching a spring load before it releases. It is the first signal, and it sets the architecture for everything that follows. Before we go to signal 2, there's a drop comments line I want you to use. Drop a comment right now telling me where you're watching from. The city, the state, wherever you are. The recession warnings community watching this is global, and I want to see where tonight's data is landing. Drop it now and keep watching. The number that should have led every financial broadcast this week is not on the silver chart. It is in the Producer Price Index. March PPI printed a year-over-year increase of 4%. The steepest annual wholesale inflation reading in more than 3 years. Month over month, it moved 0.5% in a single calendar month. Peter Schiff has now formally stated that 2026 PPI could surpass the 6.2% annual reading recorded in 2022 and may reach the 10% surge that defined 2021, the period that produced one of the fastest precious metals re-ratings in recent market history. Here is what PPI actually measures and why it matters more than the CPI headline that leads the nightly news. Producer prices capture what manufacturers, logistics operators, and distributors pay at the wholesale level: raw material inputs, energy, transportation capacity, the entire cost stack that precedes any product reaching a consumer shelf. The transmission delay from wholesale cost increases to consumer-facing prices is historically 3 to 6 months. There is no mechanism by which a business absorbs a sustained wholesale cost increase indefinitely. Every persistent PPI spike in the documented modern economic record has moved through to the consumer price index on that timeline. Every single one. Now add the energy variable that no conventional monetary policy tool can address. The disruption to global oil supply from the regional conflict in the Middle East, with the Strait of Hormuz constrained and over 600 vessels effectively stranded, has sent energy input costs through manufacturing supply chains in a way that raising the federal funds rate cannot touch. Supply-side inflation does not respond to rate hikes. Increasing the cost of borrowing does not increase crude production. It does not reroute stranded shipping capacity. It does not reduce the cost of energy-intensive transportation. What it does is layer a credit tightening effect on top of a supply shock, raising input costs from the monetary side while the physical supply side remains constrained. That is not a manageable policy environment. That is the scenario that produces the most acute and sustained purchasing power destruction of any inflation type. And every documented instance of supply-driven inflation in the modern era has produced outsized performance in hard assets as capital searches for anything that preserves what the currency cannot. Signal 2 is in the PPI data. It is already in the system. Now let's talk about what the dollar just confirmed from a completely independent angle. The US dollar index was sitting above 100 last week. In under 7 trading days, it collapsed below 98, erasing the entire safe haven premium that accumulated across an entire active geopolitical crisis. Gone. In the same calendar window where financial television was still running segments about why the dollar was the place to be, Peter Schiff framed this precisely, and it matters. The dollar gave back everything it gained during the war, not gradually, not across weeks as the geopolitical situation de-escalated. It gave it back at the speed of institutional capital flight. Those are two completely different market dynamics, with two different implications for what comes next. Geopolitical arbitrage unwinds gradually as the situation cools, pricing out the risk premium in proportion to the perceived reduction in threat. What happened to the dollar was not that. What Schiff identified in that move is a market that tried to hide in the world's reserve currency during a genuine crisis, discovered the hiding place was already structurally compromised by the purchasing power trajectory of the currency itself, and exited with urgency. That is not a position reversal. That is a structural conclusion about the currency. And structural conclusions about reserve currencies do not re-reverse when a ceasefire headline drops. When the dollar retreats from a safe haven position at that velocity, the capital that exits does not sit in money market funds earning negative real yields while inflation prints at 4% and climbing. It finds purchasing power protection. It finds hard assets. That capital movement is signal 3, and it is already in motion. Here is where signal 3 connects directly to the silver market, in a way the current $80 price has not incorporated. The COMEX silver futures market is not a physical silver market. This is not a philosophical point about paper versus metal. It is an operational fact with direct and measurable consequences for what happens to the silver price when institutional buying returns. The futures complex is dominated by participants with no intention of taking physical delivery. Trading firms, managed money accounts, algorithmic strategies, and bullion banks that have maintained structured short positions in silver futures for years, rolling those positions forward from contract to contract in a mechanism that continuously exerts downward price pressure regardless of what the physical supply and demand balance is doing. These short positions do not disappear when silver begins to move higher. They do the opposite. As the price advances, the mark-to-market loss on every outstanding short position increases, creating margin pressure that forces covering, which means buying, which adds momentum to the move, which creates more margin pressure on remaining shorts, which forces more covering. The sequence is self-reinforcing. It does not operate at a gradual pace. It gaps. It moves and jumps. It leaves behind everyone who was waiting for a technical confirmation that the advance had already started. Silver moved from approximately $61 on March 23rd to $80.20 tonight, a recovery of approximately 31% in under 30 days. That move happened while hedge funds were still sitting at 25-month lows in precious metals positioning. It happened while the institutional bid was still on the sideline. It happened against a paper market with structurally short positioning from the bank participants. And it happened in what Hansen specifically described as a rebuilding phase, a period requiring further price gains before confidence is fully restored, before trend. Following systems generate systematic buy signals before the managed money category begins rebuilding the net long exposure it liquidated during the first quarter correction. The 31% recovery was the physical and industrial demand base pulling the metal back. The institutional reentry, the trend follower activation, the systematic buying Hansen described, none of that is in the $80 price yet. The move that already happened occurred without that fuel. What comes next has it. That is signal 4. Gold is communicating something specific through its technical structure right now, and the signal is precise enough that Ole Hansen named an exact price level that every viewer of this channel needs to know tonight. Gold bottomed near $3,180 on March 23rd, bouncing directly off its 200-day moving average, the most universally monitored long-term technical support level in institutional portfolio management globally. The 50% Fibonacci retracement of the full decline from gold's January all-time high sits at $4,147. Hansen identified this level by name as critical resistance. He stated that a sustained break above $4,150 would likely trigger renewed momentum and systematic buying from trend-following strategies. Systematic buying from trend-following strategies is not a subjective call from a human analyst who changes his mind when the narrative shifts. It is an algorithm executing a buy signal when a quantitative threshold is crossed. It is coordinated, simultaneous, and self-reinforcing across the strategy type. When gold crosses that level, the buying does not arrive gradually. It activates at once across multiple strategy types. Gold tonight sits at 4,825. The Fibonacci trigger is 21.40 away. When gold crosses that level, silver does not track it at a 1-to-1 ratio. It amplifies. The documented price behavior of silver relative to gold across the last 4 confirmed precious metals bull phases shows silver moving at approximately 2 to 3 times gold's percentage gain during institutional reentry phases. That amplification coefficient is not a projection. It is the historical record of what this market does when professional capital rebuilds precious metals exposure in a confirmed inflationary environment. The current gold to silver ratio sits at approximately 60-to-1. Calculated against tonight's prices of $4,125 for gold and $80.20 for silver. The historical mean for this ratio sits between 50 and 60. At the January 2026 bull market peak, that ratio compressed toward 38-to-1. If gold sustains institutional price targets already published by major sell-side desks, and the ratio returns to simply the low end of its historical mean, 50-to-1, not an extreme reading, not a crisis compression, a median reversion, silver prices to approximately $96 per ounce from tonight's level. That outcome requires nothing exotic. It requires ratio normalization and a gold price that major institutional desks have already put in writing. That is signal 5. Signal 6 is the rate environment, and this one has a 2-year timeline locked into place by the Federal Reserve itself. The Federal Reserve has already cut 75 basis points from its prior rate ceiling, bringing the federal funds rate to 3.5 to 3.75%. Fed funds futures are currently pricing rates at approximately 4% for both December 2026 and December 2027. That curve is not pricing a rate hike anywhere across the next 2 years. Not one. Not partial, not conditional. 0. Here's what that means for silver allocation in plain terms. When interest rates sit at 4.5 or 5%, holding silver carries a real and calculable portfolio cost. Treasury bills produce a guaranteed return. Cash equivalents generate yield. An investor who allocates to silver, which produces no yield, no coupon, no dividend, is making a choice that has an opportunity cost measured in basis points per year. Against an instrument the institutional world treats as risk-free, that calculation drives allocation decisions at the margin. It explains why the managed money category can justify running a 25-month low in precious metals exposure when the risk-free alternative is competitive. That calculation is now reversing. At 3.5% in an environment where producer prices are running at 4% year over year and may reach 10%, the real rate of return on cash is negative. An investor holding treasury bills in that environment is not earning income. They are losing purchasing power at a rate that compounds against them every single month the situation persists. Silver does not compete for allocation against other instruments in that environment. It becomes the rational default for any investor whose mandate includes purchasing power preservation. The yield disadvantage disappears when the yield on alternatives has been overtaken by the inflation rate it is supposed to protect against. Consumer confidence has collapsed to an all-time low, not because the stock market corrected, but because the lived experience of prices accelerating faster than income has crossed the threshold where it registers as a structural condition rather than a temporary inconvenience. The investors documented this week as actively searching for yield hedges because inflation is eroding. Their returns are going to find that the most liquid, most historically validated, most physically deliverable purchasing power protection available is sitting at an institutional underweight of 25 months. The demand side of this equation is not in the $80 price. It has not entered the market, and the Fed has locked the rate environment that drives it into place across a 2-year forward curve. Signal 7 is the one that separates this moment from every comparable period in which silver mounted a significant bull phase during an inflationary cycle. The 1970s, the post-2008 reflation, the 2020 to 2021 run. In every prior instance, the Federal Reserve held a genuine policy option. It could raise rates. It could credibly commit to a tightening path that would reduce the forward inflation premium embedded in hard assets and draw capital back toward fixed income. That option does not exist in its prior form today. The Fed raised rates to 5% across 2022 and 2023 and had to begin reversing within 18 months because the economic foundation could not sustain the weight. Consumer debt, corporate debt, government debt service costs, all of it calibrated to a rate environment that breaks above 5% at significant systemic cost. The Fed already knew this. The 75 basis points of cuts it has already delivered confirm it. The futures curve showing no rate hikes across the next 2 years confirms it again. Supply-side inflation driven by energy costs and logistics disruption, the precise inflation type currently operating through the Strait of Hormuz constraint, and the global shipping backlog cannot be fought with rate hikes at any level the current economic structure can absorb. Raising rates does not increase oil output. It does not unblock stranded shipping. It does not reduce the cost of manufacturing inputs when the physical supply of energy is geographically constrained. All rate hikes do in this environment is add a credit tightening layer on top of the price shock, making it more expensive to borrow, while the underlying cost of everything businesses actually buy continues to rise. The Federal Reserve is operating inside the exact policy frame that has historically produced the most sustained and consequential hard asset rallies in modern monetary history. An inflationary environment it cannot slow. A rate tool it cannot deploy aggressively enough to matter. A currency that is already retreating from safe haven status. And an institutional investor base running historically light exposure to the assets that benefit most from every one of those conditions simultaneously. That is Signal 7. Now here is where I owe you the complete picture, always. In less than 2 weeks from March 30th, the S&P 500 added approximately $6 trillion in market capitalization, characterized by the COBC letter formally and specifically as a historic short squeeze. Not a recovery, not a sentiment shift, a squeeze. Hedge fund short exposure to U.S. equity ETFs went from its highest reading since May 2025 to below the 97th percentile of the preceding 5-year range in 5 trading days. That is forced liquidation at whatever price the market offered to prevent fund-level losses from reaching margin call thresholds. Capital came out of precious metals to cover equity losses. The institutional underweight that resulted is now documented and measured, and the capital that moved after the squeeze is also documented. Technology names, artificial intelligence companies that had compressed to historically anomalous valuation ratios during the correction, absorbed the rotation. Professional capital identified the entry and moved at speed. If equity markets continue to advance, if the AI re-rating becomes a sustained institutional theme rather than a short squeeze recovery, the marginal dollar that the inflation narrative suggests belongs in silver does not arrive in the metals market. On the timeline the positioning math implies, it arrives late or smaller. The geopolitical premium currently embedded in gold is a variable, not a constant. If ceasefire talks produce a formal agreement and the Strait of Hormuz reopens, oil prices will retrace. And with them, the supply-side inflation catalyst that gives the 10% PPI scenario its most immediate near-term fuel. Silver proved between late January and March 23rd that it is fully capable of a 30 to 40% decline in a compressed time frame when the macro narrative reverses. A position correct on direction, but early on, timing can generate a loss severe enough to remove someone from the trade before the thesis resolves. 4% year-over-year PPI is a serious number. 10% is the tail, not the base case. Hansen at Saxo Bank, while identifying a precise breakout level in gold, simultaneously described silver as being in a rebuilding phase, not yet confirmed in trend terms, requiring further price gains before institutional confidence is fully restored. These are real constraints on both the magnitude and timing of what the data is pointing toward. Anyone presenting this thesis without them is not giving you the complete information set. I'm not a financial advisor. What I do is read primary sources and show you what the data actually says. What you do with it is entirely your decision. But here's what every one of those counter-arguments cannot account for. The dollar index erasing its entire war premium in days is not a geopolitical arbitrage trade being closed. Geopolitical trades unwind at the pace of the situation de-escalating, gradually across sessions and weeks as the risk premium prices out in proportion to the perceived reduction in threat. What happened to the dollar happened at the pace of institutional confidence flight, the velocity of a reassessment, not an unwinding. The market tried to hide in the world's reserve currency during a genuine crisis, discovered the hiding place was already structurally compromised by the purchasing power trajectory of the currency itself, and left its speed. That is not a position reversal. That is a structural conclusion. Structural conclusions about reserve currencies do not re-reverse when a ceasefire headline drops. The $6 trillion equity rally does not compete with the precious metals re-entry indefinitely. It creates it. The funds that covered equity shorts at any price during the historic squeeze now hold gains denominated in a retreating currency. In an environment where producer prices are running at 4% and may reach 10%, gains that erode in real terms at an accelerating rate unless they are redeployed into purchasing power protection. The equity rally is not an alternative to the silver trade. It is the mechanism that creates the surplus institutional capital that rotates into inflation hedges on the following cycle. The COBC letter stated it directly this week. Investors are actively searching for any source of yield as a hedge against the inflation data already in the system. The hedge fund positioning data is not a forecast. It is a measured number from one of Europe's most rigorous institutional research desks, 25-month low, week ending April 7th. The last time that number was this light, gold was at $2,000. Gold is now at $4,825. The institutions carrying nearly the same structural underweight they held at the beginning of the current bull market are not permanently repositioned away from precious metals. They are running a portfolio exposure level that their own mandates, their own inflation-sensitive client bases, and their own real rate arithmetic will force them to rebuild. The re-entry is not priced. The amplification that silver applies to gold's directional move, 2 to 3 times gold's percentage gain across documented historical re-entry phases, is not priced. The systematic algorithmic buying that activates when gold crosses $4,148, sitting $21 from tonight's price, is not priced. Silver moved 31% from $61 to $80 without any of that institutional fuel engaged. It moved on the physical and industrial demand base that did not stop pulling metal through the correction, regardless of what the paper price did. The next structural move, with 25-month institutional underweights, negative real rates across the 2-year forward curve, a retreating dollar, a futures complex loaded with short paper positions that amplify upward moves, and a systematic buy trigger sitting $22 above tonight's gold price, has a fuel stack behind it that the move, which already happened, never had. Here is where every number in this analysis stands as of tonight. Silver at 80.20, gold at 4,125. The Fibonacci trigger $21 away. Hedge fund precious metals positioning at a 25-month low. Federal funds rate at 3.5 to 3.75% with no rate hikes priced across the next 2 years. March PPI year over year at 4%, the highest in more than 3 years. The World Silver Survey 2026 published today. A 31% recovery in silver completed without a single dollar of institutional reentry. The screen at 80.20 is holding 2 separate and irreconcilable interpretations of the same asset in suspension. The first is what the current price reflects, a metal in a documented rebuilding phase, institutional positioning still light, confirmation of the next trend requiring additional price gains. That interpretation is not wrong. Every element of it is factually accurate. And if you're waiting for a price that reflects it, you are looking at it right now. The second interpretation is what the primary source data is communicating simultaneously. A currency that erased its entire safe haven premium at the speed of institutional confidence flight. A central bank that has delivered 75 basis points of cuts with no rate hike optionality against supply-driven inflation and has locked that constraint into a 2-year forward curve. A hedge fund community carrying the lightest precious metals exposure of the last 25 months while holding equity gains that erode in real terms faster than the inflation rate the PPI data is already signaling. A technical trigger in gold sitting $21 from tonight's price, above which algorithmic and systematic buying activates across the professional strategy space. And a silver market that demonstrated through the 31% recovery it completed without institutional participation that the physical demand base does not wait for the futures narrative to catch up. These 2 interpretations do not coexist indefinitely. The price mechanism resolves them every time, without exception, without announcing the specific session in which resolution begins. The gap between the screen and the primary source data is the entire trade. The screen will catch up. It always does. It just never tells you the exact moment it starts. Invest with logic, never with noise. Hit the like button right now if this data landed differently from what the financial news cycle gave you today. It helps more people find this analysis before the price makes the question academic. Share this with one person who is still reading $80 as a ceiling rather than as a position inside a documented re-entry setup that has not yet received its institutional fuel. Subscribe and ring the notification bell. The World Silver Survey 2026 published today, and I will be back within hours to walk through every line of the full supply and demand tables and explain precisely what the official annual deficit number means when you place it alongside the positioning data, the rate environment, and the Fibonacci trigger sitting $21 above tonight's gold price. Drop a comment below telling me where you're watching from. The recession warnings community was built on positioning filings, producer price data, and central bank communications. On the patient work of reading what institutional capital is actually doing, not what a financial television segment says it should be doing, watch the dollar, watch the hedge fund positioning, watch gold at $4,240. The screen will catch up.